pleasure to be on the show. And this is my first time. I hope we can be sharing something rather interesting with all of our audience here. Let me start with an introduction of myself. My name is Theo. I have been with Skybound Capital Group for over 10 years as the CIO of the group. We obviously allocate capital across different asset classes, from the conventional equities, fixed income, to the more alternative private markets, real estate, hedge funds. In my early part of my career, I was teaching economics, and I was also working as an investment manager across different parts of the world with banks, family offices. I have always been enjoying this career, not only for the fact that it can make me some money, but also because it is a educational experience every single day. When we are in investment, when we are in markets, we come across new things every day, and we are forced to educate ourselves on those.
And it's interesting, Theo, because I know one thing that I studied a lot in Paris was I studied quite a bit of economic history. And one thing that we tried to get out of economic history was, what are the patterns? What are the themes? What did we see in 1929? What were the lessons that we could then apply, however many years that was later, sort of 90 years later or so, or 80 years later, as it turned out. So trying to think, trying to find those patterns, but at the same time, everything is new.
I agree. Everything is new, but I also agree there are always patterns. Those patterns probably have nothing to do with a specific asset, a company, or the market. The patterns have everything to do with human beings, because all the market participants are people. And yes, the specific instrument you were trading 100 years ago was a company that no longer exists today. And today there are people who trade crypto. But again, as I said, behind the scene, it's always people.
And I guess when you have sort of psychological stuff that doesn't necessarily change, people's psychology with investments, people's relationship with their money, people's relationship with their financial assets, then you'll see those ebbs and flows. You'll see those periods of how should we say, adrenaline, excitement, and things going in the right direction, followed by the aftermath after that. And I guess that, there's lots of examples. I think one question that I had for you today, Theo, which we'll go on maybe a little bit later in the Chinese context, was with Evergrande, and whether there were any of those types of lessons there around, did they expand too quickly? Were they too excited with the debt? Was there a certain sense of optimism that suddenly maybe went over a cliff after a certain point in time? I think just before we go on that, what I really wanted to cover today is really just looking more broadly at equity markets and trying to look really focus on stock markets more specifically. I think initially there's a lot of chatter, and sometimes I hear it from clients, sometimes you read it in the mainstream media, in the press and so forth, that there's a sense that the equity markets are overvalued. Okay, there's a sense that maybe we're at all-time highs, the bubble's going to pop at some point. Now, people have been saying this really for a few years now. Just I wanted to get your thoughts on that, Theo, around, I mean, do you think equity values are overvalued? Have we got to a point where the values themselves in financial stock markets are actually divorced from the fundamental values of the companies?
Absolutely. I'm very happy to elaborate on this, and I think I can easily talk hours and hours on this. But two quick questions first. One, what is a market, or what are equities when you refer to equities, or when people think of equities? I guess many people will suddenly come up with an index. Let's say for the Americans, probably equities means S&P 500. And for most of the other investors, maybe that's MSCI World. So when we talk about the market, when we talk about the equities, we are trying to refer to it as a collective idea and that is a market. But the difficulties that we come across today is, does that index actually represent the market, right? And is it telling us how equities in general are doing? And if it is not, then what should we be looking at? I can't say I have the best answers or solutions, but let me give you a rough idea. If I take NASDAQ 100 index as an example, it's simple because in the name it has 100. It actually has more than 100. It has 102 constituents in the index. Year to date, it's still positive after the big pullback in the past week. It is still positive. It is up more than 10% year to date. However, if we look at the underlying 102 constituents, I can tell you this: about 40 of them are negative for the year. And the majority of them are performing worse than the index itself. The majority of them are doing somewhere between negative 10% to positive 5%-ish. That's how most of the constituents are performing.
Relative to previous performance, is that?
No, relative to the index performance itself.
Okay. Yeah.
And then people will ask, okay, how come, right? Like, why is the index not reflective of most of the stocks' performance? Because it depends on how the index is constructed. That index is similar to many other indices that we use in the world that are market cap weighted. And for example, the single largest position is Google, and Google is up a lot this year. So that skewed the index significantly. That makes the index less representative of all the tech stocks. I mean, because whenever people talk about NASDAQ, people think of tech stocks. It is more representative of one stock in a way.
Sure.
So I was using that as an example. I'm just trying to show people that it's difficult to really find or define the equities or the equity market, right? And the dispersion today that we are seeing in the market is tremendous. There are stocks that have been fallen by more than 90% just within months. But at the same time, there are stocks that went up several fold during the same period. And all of them are in the same market. But would you say it's very easy to generalize, okay, how stocks were performing during that period? I guess not. I think it is very difficult. So that's the first question, and I want everyone to spend some time to ponder on that. So what is stocks market? What is equities? How do you define that, right? And the second question really is, okay, overvaluation, undervaluation. In the diction itself, it implies comparison, right? Then the question is, okay, what are you comparing this to? Again, if I use Google as an example, okay, if we say Google is overvalued today, are we comparing its valuation with the same valuation of the same company a year ago, 2 years ago? So that's more a chronicle comparison, right? But then you can also say, okay, I want to compare it with Facebook. So that is also a type of comparison. But again, back to my point, when you say overvalued, undervalued, it really depends on how you conclude your comparison, how you can do the comparison. And also, more importantly today, I think the investors who are arguing that stocks are not overvalued primarily derive their support from the comparison with other assets, sure, with particularly bonds, right? Because I mean, back in the late 80s, we had global inflation in double-digit range. And also globally, central banks had their benchmark rates at double-digit range. Then, okay, for equities, you really need to perform very well to beat the bonds, or you really need to deliver good returns, right? But then now, okay, yes, I know there's this hyper of discussion around inflation in the market in the past 12, 18 months. And we are seeing concerns around Fed tapering and potentially hiking rates. Still, you are based in Europe. You are seeing negative rates in most of the places, and the banks are charging depositors money for putting money into the banks. And therefore, in that context, if the stocks are delivering, let's say, a 2% dividend yield, that is already outperforming pretty much all the treasuries out in the whole world. And therefore, if you draw that comparison, stocks are not overvalued at all. And then the question is, okay, we talk about valuation, but exactly how do you value a stock today? I mean, for those who have been doing a lot of research and studying in equities, economics, you probably know people use discount cash flow, people use price to earnings, price to sales, etc., etc. However, that is not going to work for today's market, because imagine this: many of the companies out there are loss-making. Many of the companies out there do not even have a top line. I mean, they're not necessarily generating any revenue as yet. So how would you be able to use either their S like sales, or E like EPS, or future cash flow? You don't know the future cash flow. Yeah, you can dream of the future cash flow, but is that reliable?
So do you think, in your view then, Theo, because obviously it's a key question then around overvalued, undervalued relative to what? And I think that
right.
the common response that I hear when I meet that accusation, and I say, okay, well, because I push it back on the clients when they ask me, well, I think the equity is very valued. Okay, well, relative to what? Relative to bonds, relative to fundamentals, and most of the time it's relative to fundamentals. They say, well, actually, when you look at the companies, you do the PE ratios, you do your future dividends, and so on. It doesn't stack up. It doesn't stack up. It doesn't. These markets just seem to be overvalued. But then if you're at a situation where the markets are dominated by a few key players, and you have that disconnect between the majority of companies are underperforming, or they're loss-making, or whatever it may be, then I guess the normal rules of engagement almost don't apply. So how do you assess whether value is there or not if the normal rules of engagement don't apply?
I think in our day-to-day life, when we are making investment decisions for the funds that we manage, or for our clients who are interested in single names or equities in general, our approach has always been, first of all, we don't look at the markets. We don't actually care whether S&P was up or down yesterday, or the day before, the week before. We care more about specifically what you are buying, whether you are buying this company or that company, and more importantly, whether these companies, I guess two steps. Number one, whether they will still be there in 5 years' time. That probably is no longer a question that comes to mind to a lot of investors, but I can almost assure you that the turnover, I'm not talking about the trading turnover, I'm talking about the name turnover, is going to be very big in the following years. And I can give a comparison very soon. And the second step really is this company going to do better? We don't compare it to anyone else, just itself. In 5 years' time, is it going to be a better company than it is today? So those are the very, very basic questions. We are not even coming to the stage of valuation or how to assess the company as yet. But I think we start with those two questions first. And if the answer is no to either one of them, the quick suggestion will be, let's drop this name and move on to the other. Now, let me elaborate a little on the first point. And I said the turnover is high. 20 years ago, let's just use US market as an example. 20 years ago, the number of listed companies is close to 10,000. And today, the same number of listed companies is half of that. This probably is contradictory to many people's perception because particularly in the past 2 years, the capital markets have been very active. You see a lot of specs, you have a lot of IPOs, prominent companies going public, et cetera, et cetera.
Yes.
But the reality is there are more companies dying and there are more companies being taken private. The overall market is in a way smaller than what it was like before. So I wasn't exaggerating when I say the first step is we need to assess whether the company will be there in 5 years' time. And it doesn't necessarily mean it will demise. It could be bought out by someone else. For a shareholder, you will say, oh, no, this is not a bad outcome. If they buy out the company, I'll get paid anyway. But then the question is, at what level would they be bought out? If you do some brief research into a lot of the privatization deals in the past, you will note that very often the share price tanked first, like by 70, 80%, and then White Knight will come out, offer you 40% premium on the spot price. Yes, it is a 40% premium, but most of the shareholders actually had their cost up high.
Sure.
And when that privatization actually took place, most of the people didn't get the full compensation they were anticipating. And hence, in the hedge fund world, now there is a very niche strategy, litigation, which is focusing on suing companies that were taken private cheaply. And so I would say, back to our discussion points, how we look at the market, how we judge whether the company is overvalued or not. Again, if it is a good company, if it is generating cash flow already, and if we think it will do better in the following years, that is something that we will be interested in. And ideally, whatever ratio PE, PB, PS is relatively low. And actually, you know what, I can say that is the case for many of the large names out there. I mean, people might think, oh, FAN is such a cliche and they will be out of favor sometime in the future. But the reality is the very large names, they're not just large in terms of their market cap, they're worth a lot. They're large in that they are big companies themselves today as well. And nowadays, in an environment when there's more hurdles of compliance, there's more hurdles of literally just doing business everywhere, being large actually gives you a lot of advantages. And that makes it more viable to run on an ongoing concern. And this is why, in comparison, I would say many of the large companies are actually not overvalued at all. And again, even if we resort back to the very traditional measures, be it PEPS, you would note that they are, in fact, very reasonably priced by any one of those measures. It is, however, in comparison, the relatively smaller companies, many of the startups or quasi-startups who are still struggling to find their way in this whole world are being valued at an unreasonable valuation today. And in terms of number, I would say there are probably more of those smaller companies that are unreasonably valued than the large companies that are reasonably valued. And this is exactly where some of the biases, some of the misinterpretations might come in because you are looking at
Sure.
different segments of the markets.
Interesting. Now, another thought that I had sort of related to that. So thinking around ultimately that relationship between the value of companies in the market, the value of the market itself, and what are the factors that influence that over time. One thing that we've seen, particularly in the last few weeks, is ultimately the impact of monetary policy. And we're almost finding that today, and I don't know whether you agree with me or not, but almost today, more than many other times in economic history, the words and the actions of central bankers is having a huge impact on financial markets. Do you see that yourself from your own perspective? Do you think that the influence of central banks today is higher than it's been historically speaking? And do you think that that itself has lent or given a certain vulnerability to markets, and that they're reliant on the behavior of central banks now in a way that they simply weren't before?
Okay, I'll address this in two steps. First of all, again, I circle back to my discussion around the markets. What is the market and what makes of the equities, etc. All the indices that I used as examples have significantly evolved over the years, actually every single year. So yes, many people say, oh, S&P 500 is now at whatever level, and I compare it with a year ago, 2 years ago. But the reality is such comparison is never reasonable, because this index today is very, very different from the same index a year ago. So if you make that comparison, whether that makes sense or not, right? And then back to the question on monetary policy, I think I hope I can provide a very, very different perspective. It's not just about whether it has influence or it has big influence, etc. I mean, I can definitely provide my short answer. I think monetary policy significantly impacted all capital markets, and not just equities, in the past 10, 20 years. But that's a key point. This is not new. Yes, we are hearing QE, 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 but come on, QE has been there for over 10 years too. Time really flies, and many investors who are in the market don't even realize that. So the kind of impact that easing monetary policy has on the markets have always been there. Yeah, we can comfortably say that they have always been there for a while, and the impact should be fully priced in, by the way, because there are more people looking at central banks moves or projecting central banks moves nowadays than possibly 20 years ago or 30 years ago. And of course, we're not just talking about stock pickers, commodity traders, for example, and everyone, literally everyone in the market are watching very closely how central banks are making a move, etc. But the fresh perspective I want to really provide here has less to do with, okay, what if tapering comes and rates are higher? What kind of impact that will have on the market? But let's take a step back. See, apart from the higher and higher valuation across assets in the past decade, are there any other results or impact coming out of that? I think the key point that many investors should also closely look at is really the wealth gap, the divide between the haves and the have-nots. You might think, okay, this doesn't seem to be related to the market directly, but tell you what, it totally is, because economics is not completely separable from politics in a way, and both are interconnected. We are seeing that across the world. You're seeing the divide, the uprise of populism everywhere. And a big factor that led to all those is exactly the quantitative easing, the very loose monetary policy that we saw in the past 10 years. The haves never had assets. They could never lever and they still do not have assets, and they don't have leverage. Whereas the more privileged, they had assets and they had access to leverage. And the past 10 years of bull market actually offered them additional rewards from the financial markets, which aggregate the situation of the wealth gap that we're seeing today. And unfortunately, I should say fortunately, many markets, many governments have realized this long ago and are trying to do something about it in different ways. We are seeing that. So I think that possibly will have even a bigger impact on overall the markets in the next 2 to 5 years, comparing to just the monetary policy itself.
But I would push back a little bit on that, Theo. And I said that one of my professors at the Paris School of Economics was Thomas Piketty, who's done a lot of work on inequality around the world and wealth distribution and all these kind of things. And it's been, I mean, we remember whoever the chaps were sitting on the steps in London, in the city, and protesting and so forth back in 2009 and so forth.
Yeah. Yeah.
I guess the question is, well, yes, we've seen monetary policy actions have almost undoubtedly fueled inflation in asset prices, both for financial assets as well as real estate in developed markets around the world, which has then benefited those who already had those assets. So 50% of the population don't own property, 50% of the population don't own shares, equities, any type of financial investments. They've missed out on all of that growth. So that we're going to see that dispersion, that bifurcation continue. The question then is, well, this isn't necessarily a new point. I mean, this has been in place for at least 10 years. People have been thinking about these questions, but we haven't really seen fundamental changes in government policy. We haven't seen fundamental changes in taxation or the tax systems, the international tax systems. Earlier this year, there's been talk of fixing sort of corporate minimum, tax minimums, and so on and so forth, and trying to instill a sense of control in that dimension. So I'm not sure that even with a Democratic president in power in the US, you're going to see a fundamental change in that perspective. I mean, look at what's happened to US house prices, double-digit growth over the last year. In the UK, Chancellor Rishi Sunak did his stamp duty holiday, which benefited those who were obviously had property or looking to sell, and so on. Sure. So in many ways, those policies have done the opposite, the inverse. And then you're at a situation where monetary policy, they're afraid to do anything more than baby steps. Interest rates are going up in baby steps. Tapering is baby steps. They're not just going to stop the taps. They're going to slowly turn the tap off very, very tiny. And as soon as there's panic in the markets, as soon as there's a big pushback, suddenly they'll turn it back on very, very quickly, which we've seen over the last 10 years as well. So whether we see that in as short a horizon as 3 to 5 years, I'm not sure. I'd be happy to be proven wrong. But when you have populism, with certain
I am with you 100%. And I just say this, I'm probably too optimistic a guy myself. And I'm wishing for that direction, although it might be at the expense of many of our colleagues, many of our peers in the industry, because we probably are more belonging to the guys who benefited from all these. But you're right.
I guess what form do you see that taking? Is it a case of trying to increase financial asset ownership? Is it a case of trying to reallocate wealth, redistribute wealth in a more top-down way? So do you see it more top-down, or do you see it more trying to be organic, pushing people up?
I think it is more top-down, and I can explain myself a little. I'm definitely biased. I'm biased because I'm situated in this part of the world. I'm currently located in Hong Kong. Obviously, we watch China very closely. I agree with all that you said just now. I think US, UK, Pan-Europe is probably not going to move very swiftly, fast on solving the issue I touched on just now. But from China, at least, we are seeing, back to your point, more a top-down shift gradually. Many people, investors, were complaining about the tons of regulations coming out of China in the past few months, etc. But there is a key theme, and the theme remains the same. The theme is really about bridging the gap. The theme is, by the way, I think a lot of investors also interpret it wrongly in that, okay, you guys are trying to take some money from the rich to fund the poor. No, that's not what they have in mind. What they have in mind is to grow the pie bigger, but then cut a slightly larger slice to the guys who missed out previously, and cut still a bigger slice than before for the privileged, in a way. And it is top down. It has a lot to do with the devising of different types of mechanism, including taxation and property tax and everything. It's not going to be an overnight overhaul, but I think we should anticipate gradual change. Would you see a big contrast in 5 years' time? Maybe not. Again, I admit that I was being too optimistic, but I think in a way China is heading the right direction, and it has nothing to do with okay, moving away from private sector and nationalize everything and try to redistribute wealth. No, that's not the approach. The approach is really, as I said, the stats are, or yeah, let me give you the numbers. So in the past 20 years, the relatively wealthier portion of Chinese population, let's say the top 10%, they have seen their wealth grew by about 13 times. And during the same period, the relatively less wealthy, let's say the bottom 50% of Chinese population, have seen their wealth grew by about 6 times. So the thing is, both have grown, but at different paces.
Yep.
So what I can imagine going forward is, obviously the government is trying to fine-tune this pace a little, and hopefully to make the haves and have-nots at least grow at the same pace, and preferably to have the have-nots grow at a slightly faster pace. Not to the extent that they can catch up, but at least to kind of make up for a little bit of the momentum they lost in the past 2 decades. So that's what we're seeing.
And that's always the challenge, to find that balance. I know there's Peter Mandelson, who was quite a senior fellow in the Labour government in the UK before 2010. One of his infamous sayings was, "We're very comfortable about people getting filthy rich," and the bit that people always forget at the end is, so long as they pay their taxes. And the point being that we're quite happy for the rich to get richer, so long as the pie is growing and some of the poor can also take a share of that. I guess if the multiple is 13 times at the top end and 6 times at the bottom end, it's always going to be a divergence ultimately. The risk being you try and correct that, and suddenly you take out the steam of the overall pie itself. I guess sort of thinking about just with a little bit more in the context of China, and I know we've seen obviously the Evergrande story recently and things blowing up there a little bit. There's been a bit more noise over the last couple of months around sort of debt in Chinese public sector institutions. To what extent do you think that the Chinese economy, sort of very much like many developed economies around the world, has managed to fuel its expansion through debt? And do you think that China is different? Is there a debt crisis facing China in the future, either at the company level or at the national level? And is that going to impact how either foreign investors, in the Evergrande context is interesting there, foreign investors choose to put their money into the Chinese economy, and how China itself is going to be structuring its economy going forward?
I think China is definitely different. different in many ways. For example, it wasn't replicating its own growth mode from anyone else. And similarly, I guess that no other country can also replicate exactly how China grew. I'm not talking about the pace. Obviously, there will always be markets that grow very fast at any given year or during a period. But just the mode itself will be different. And that has a lot to do with the piling of debts that you are talking about here. And I think it really traces back to, okay, I talked about the mode. So how exactly was China growing, and what kind of mode, what kind of route they were following? In the past 20, 30 years, I guess many people didn't know that China entered WTO about 20 years ago. So that really was when China opened its domestic product market to the world, and also China gained access to the global markets to sell its own products too. So historically, I think China was interesting in a way that, okay, many people still associate it with communism. We are not talking about ideology today, but China is managed like a company. Okay, China is managed like a company because China is so big. So there's the central government, and there are the regional governments or the local governments. But then it is different from US. It's not like all the local governments have that much autonomy.
Yes.
They're all listening to the central government from a ordering pack perspective. However, when it comes to managing the economy, every single local location actually has great autonomy. Not just the autonomy on guiding where the economy should be headed, but also on how their performance is measured and how they set up their own target, etc. And there's a lot of bargaining with the central government in many ways. It sounds like this has nothing to do with the debt topic we have today, but it has everything to do with the debt topic because, again, China experienced several reforms during the course. Many of those reforms are related to taxation and exactly who collects tax. Like whether it is the central government collects the tax, whether it is the local government, or how they split this. And this has everything to do with their leverage decision. Because if you don't collect the tax, you wouldn't be able to borrow. No one will lend you money because they know you don't have assets. They know you don't have the future cash flow, right? So all those reforms China had in the past many years actually enabled the local governments to have access to capital markets, not necessarily directly through themselves, but through their subsidiaries and other associated companies, and some of those are SOEs, etc. So that's how the debt was gradually growing. But then we also need to look at the other side of the balance sheet, right? Okay, you're getting more and more liabilities, but what about your assets? What exactly are your assets? So in the case of China, as I said, this is slightly different from many of the other experiences that we see in other markets, in that the debt was not used to fund consumption. The debt was not really used to fund the gap, like we've seen in the past, austerity in Greece, for example, right? So that kind of debt is very different from the debt that we're talking about in the context of China. The debt in China was all used to infrastructure and properties, etc.
Yeah.
Which part of it will have something to do with the Evergrande story they mentioned. But the infrastructure, okay, China was really thinking quite ahead, in that when they were building those roads or the rails, there was no need and demand for those roads at all. However, by the time they complete the construction, or 1 or 2 years after they complete the construction, you will see that all the roads were used like to their full extent. So the pie that we talked about was growing gradually, and in a way, China was trying to project what might happen in the years to come. And that projection worked out very well for a long period, till recently, I would say, because there's only that many roads and bridges that you can build. And that logic doesn't just apply to the investments, to the infrastructure, but also to the overall output. That's why I mentioned WTO. That's why you're seeing trade conflicts with the US. You're seeing China being the primary exporter of everything to the entire world. That's because of all those investments that I talked about from borrowed money. The output was the bridges and the roads, as well as the products, the made in China products that you are seeing. So the bridges and roads will be used, and the products will have to be consumed if they are not consumed domestically. So they will have to be exported. And when you're exporting too much, your trade partners are getting angry. But back to the investment-driven growth that we were talking about, it is losing steam. It is not just losing steam because you can no longer build those roads, as I said, but also because of the marginal utilities that it can actually generate, right? The efficiency is getting lower and lower. So in the old days, when you put on $1, you get $2 back. But now when you put on $1, you get 1.001 back.
Sure.
It start to no longer make sense. So that was the China growth story. And this is exactly why I was talking about fine-tuning the pace, regrowing the pie, but try to control the pace of the rich and the poor. Because China has come to the stage that it has to rely very much on its own consumption.
And I guess that there's a bigger picture there as well, because many economies, they transition from agrarian economies focused on agriculture through to manufacturing economies, through to servicing economies. China, if I understand it correctly, is in that phase of going from manufacturing to services. And that's in many ways a natural evolution. Wages go up. You know, at the initial stage, cheap labor makes it very efficient, both domestically and globally, to be producing everything locally in China, for example, and exporting to the world. But there will come a point where wages are going to increase up to a point, living standards go up, where it's not affordable anymore, and suddenly Africa will be the new manufacturing base, in my view anyway. That's obviously a disputed position, but that's my view in any case. The question then becomes, in the Chinese context, is as they continue to educate, because education is a big question in China. I know we've seen them buying up international education institutions, studying in Paris. Many of my colleagues were Chinese. You go to other British universities are extremely reliant on Chinese overseas money coming in to support them. It's going to be the same situation in the US universities, the top universities around the world. So you might end up with a situation where suddenly China is educating more and more of its population, which itself will help with that transition to services. But if at the same time education leads to, how should we say, politics and certain political views, then you've got that counter response from the Chinese government to try and manage that pressure a little bit as well. So it seems as if China, there's lots of forces it has to manage in the coming years. Theo, I'm conscious of the time a little bit. I think just finishing off, because you mentioned something very interesting, which is that China, with its long-term thinking, and obviously its political system allows it a certain privilege in being able to think long-term in certain respects, rather than the short-term cycle of elections and so forth. But that question, which I think we're just getting around to in developed economies, which is, if we can borrow cheaply, spend that money on stuff that's going to give us a return in 10, 15, 20 years, infrastructure, roads, rail, whatever that may be. High-speed rail in the UK is an example of that. Biden's infrastructure bill is another example of that. Will we suddenly see a big boost from the developed economies?
Well, I hope that's the case, because that will be beneficial to the rest of the world too. Ultimately, the China story was a good example in that it is closely interconnected with the rest of the world. As I said, it was exporting all those products, which in turn fueled its own growth. And now its growth or its domestic driven growth is taking much more responsibility because exports are being less and less likely. And similarly, back to your point, if the developed world can grow faster in a healthy mode, then it can benefit the rest of the world largely as well. Again, there's these spillover effects.
Yes.
And if we can all get the pie much bigger, then no one probably will be fighting for the largest slice because every slice will be very large anyway.
That's the plan. That's the plan. Theo, it's been a great conversation. Thanks very much. If you do have any questions on any of the topics we covered today, feel free to contact me directly. Be happy to go through them with you.